Resume. Okay, welcome back. Okay, welcome back. This is the Investing Advantage podcast. Today, I'm joined by my special guest, Mark Willis. He works with individuals and business owners, and he has something that is quite unique. I actually wouldn't mind kind of passing it off to Mark, because this is something that even just before we started to record, I wasn't even aware of. Essentially, kind of creating your own source of financing. And he specializes in helping individuals and business owners do this. So Mark, maybe you can kind of tell my audience a little bit about what you do. And then I'm always curious, like, how you got started in this, because I think that that's always, it gives good context, right? Where you kind of came from. And so I think, yeah, if you could kind of just jump off there, that'd be great.
Shane, thanks. And thanks for having me on your awesome show. Yeah, the book I was reading not long ago was a book by David Graeber called Debt, the First 5,000 Years. And it really kind of spells it all out, like how human civilization has built itself around this concept of debt. Well, I don't, it's a big book. I don't agree with everything it said. It was really phenomenal and a wake-up call for me to realize, Shane, that banking is... like we are all we use the function of banking in our lives. And the question is, what side of the table are we on, and who's controlling that part of our lives? Because honestly, banks control more of our lives than any of us would care to realize. There's an old quote by Mark Twain who said, "A banker is a fellow who lends you his umbrella when the sun is shining, but wants it back the moment it begins to rain."
So true.
And to me, that spells financial disaster. I am a certified financial planner, and the biggest wealth traps are usually around a few common things that I see with clients and people I talk with and work with. It's usually the same problems that most people are caught up in, and a good chunk of it, in fact, almost I would say all of it, has to do with banks siphoning wealth off our backs. The average American anyway, and I'm sure Canadians might be in a similar boat, maybe you can let me know that, Shane, is the average American is spending 36% of his or her income just to service the debt on their life. Wow. 36%. So if time is money, how much of your day is 36%, right? How much of our day are we working slaves to a bank? So, if we're trying to find financial independence, we can tweak what we got on our mutual funds last quarter, and that's fine. Mm-hmm. But I would contend that there's something much more efficient and effective for us to break free from, escape the gravitational pull of financial dependence, which what are we dependent on? Wall Street, banks, and traditional financing methods. So there's nothing wrong with banks. I just want to use them for my own convenience rather than banks using me for their convenience. And that's where my journey began. I was in student loan debt Armageddon, basically. When my wife and I got married, we had 6 figures of student loan debt.
Wow.
And most of that was on my shoulders. And we had to find a way to break free from that mess.
Sure.
Right? Had to reach escape velocity. And we were just servicing that stuff.
Yes.
Honestly, it felt like I'd married 2 women in college, my wife and Sally Mae. So my problem was I was looking at it like everybody else. And Shane, I guess our journey began when I started to think different, thankfully with good mentors and friends to help me, but I started to think different, look with different eyes to see how banks and the banking function could really be brought back in-house. I'd been outsourcing my banking function to other banks, and they were happy to do that to take profit off my back. But when we take the banking function back in-house, whether it's for your personal life, like I was with my student loans, or for your investing, for your real estate investing and so forth, you can become your own source of financing, fire your real estate banker, and reap the wealth that's currently getting seeped out to mortgages, lines of credit, and the like.
So how does that work? I'm very intrigued by this, and I've heard of, is the concept like self-banking? Is that the term that people use, or is there a different term? I'm kind of naive to this, so I'm gonna really dig in here and ask questions, because I'm very curious for my own benefit how this would look.
Yeah, there's lots of ways you can describe it, talk about it. And there's plenty of people out there who have, hung their shingle and said, me too, me too. I would recommend we think about this like self-banking, but there's only a few credentialed advisors, certified, authorized as what we call bank on yourself authorized advisors that have been explicitly trained. So in addition to my CFP credentials, I also went through a good 3.5 years of mentoring, coaching, training, engineering, financial classes on how to be and build essentially your own bank for yourself. So the bank on yourself authorized advisors around the United States and Canada are the very best experts to help us set this up. But what is it, right?
Yeah.
So, there's a couple hundred financial products out there. And I had to study everything from dynastic trusts to mutual funds to hedge funds, raw land, oil and gas. The whole gamut is all kind of thrown at you when you're getting some of these financial credentials. And I didn't grow up knowing this, at least, maybe other people did, but I certainly didn't come with, all the financial knowledge necessary. And I didn't even know how to budget, right? When I got all that debt, somehow they handed me all that money without even knowing if I could balance my own checkbook. So that's scary in and of itself.
Yes.
But, I guess one of the first things I try to think through with new folks that I'm working with is, what do you want your money to do for you?
Yes.
Where you put your money, as obvious as this is, Shane, where you put your money will make it act different. So if it's in RRSP?
Yeah.
It's going to act different than if it's in a mutual fund or a hedge fund or a savings account or real estate or commercial real estate.
Yeah.
It's where it goes, it'll do different things. So the key question for a lot of folks is, what do I want my money to do for me? If you could design, if we could just take the labels off of financial products for a moment and just talk about, hey, what do I want my money to do for me? If I could design the perfect financial instrument for real estate investing, and ultimately, let's be clear, ultimately for my own financial independence, what kind of characteristics would I want my money to have? And so that's a discussion I usually have with folks. And I'd love to get your thoughts on this, Shane. I mean, just some initial thoughts that some people bring to me is like, hey, I want a good, decent rate of return. I want access to the cash. I don't want it to be tied up, for 20, 30, 50 years.
Right.
I don't want there to be, any access to this through like lawsuits. If I get sued, if someone slips
protection,
in front of the commercial real estate property I just bought, some sort of protection there. What else do you think? I mean, what else is important to you for where your money resides?
Yeah, so I guess a part of that would be depending on where an individual is, right, in their life cycle, right? I mean, if you are like, I've got clients maybe in their 40s, right, and they don't have enough net worth today to be able to live off the money that they're generating, and so they're like, the conversations we're having are, how do you build that net worth? How do you build your foundation so that eventually that the assets that you own will more than replace the earned income that you have today, right? So, so to me, it would be like, how do you get your money working for you, right, in safe and predictable places? Because there's a quote, and I can't remember who said it, but something along the lines of like, I'm less concerned about the return on my money and the return of my money.
Yeah,
right? Because it's it's very easy to promise 10 or 15 or 20% returns, but if they're in highly volatile or risky investments, you might only get 60% of your principal back.
Right.
Know what I mean?
Yeah.
So, but what do you hear? Like what's the like what are maybe you can tell me a story of a client that you've kind of worked with that might be in a similar situation in their 40s or got a family. They're not in a position to be able to retire yet, but they want to get there. That's their aspiration.
Well, and retire means so many things to so many people. True. I think one thing that you said, and you brought it up, I think very articulately, Shane, is that someday income will stop. Expenses never stop. But if we don't plan for that day when we can't, do the work we can do today in our 40s, let's say, for your example, there's going to be a day where the income will stop. So what is it that's going to be generating that stream of income? I always say return on investment is less important to me than rate of income. Let's put ROI where it belongs. I need cash flow, mailbox money. And I know that the work that you do with your clients absolutely helps solve that problem in a very direct way.
Yes.
So that is a key component, is that permanent stream of passive mailbox money. And so that is one of the characteristics that I wanted when I was thinking about my own perfect financial instrument. How do I use this thing to create a lifestyle of financial freedom, not just for my own life, but I want to think 3 generations. What's that Gloria Steinem quote? Rich people plan for 3 generations and poor people plan for Saturday night.
Yeah.
So,
yes.
Mm-hmm. Yeah. So to your point there, I'm looking at all these different financial vehicles. What could I do to not only pay off my debt, student loans, but how could I use it to actually bring that passive income? How can I build a permanent and protected from creditors, predators, lawsuits? How can I get guaranteed principal, a return of my money, and maybe even a return on my money too? Let's be clear. That'd be nice.
Yeah.
So what could I do, right? That's not going to be outlawed or illegal, right?
Yes.
So it was through that discernment time and my own desire to be debt free and get my own house in order financially. And as I was doing this, by the way, I was in the midst of 2008 and 9 and 10 when I was seeing financial houses collapse, basically, literally and figuratively. I was working for a CPA who was essentially calling her clients to say, "Hey, I'm sorry, Mr. Client of 62 years old, but I just lost you half your life savings." I mean, literally, can you imagine that?
No.
So the Wall Street casino just seemed like a house of cards.
Yeah. Well, so I mean, it's one of the reasons that I probably don't attract a lot of people in your industry onto my show because quite frankly, I know that there's a place for stocks and bonds and mutual funds. I'm not here to basically say the only way to invest is in, i.e., commercial real estate or whatever. I mean, that's what I understand and that's what I focus on. But that's why I think it's so refreshing to have this conversation, because you have a perspective on the world of investment vehicles, right? Mm-hmm. So I'm trying to think how to phrase this, because I suspect each individual that you work with has different priorities. Is that fair to say? And so,
sure.
So, but what are some of the maybe principles that you focus on when you're working with clients, for example, to help them think through structuring their investments so that one day they can get to a place where, we'll just use this as one goal, right? How do I replace my earned income so that eventually, whether you're a business owner or a professional or, you're working, one day you don't want to have to work, right? You want to have that choice. So.
Mm-hmm. Yeah. Well, principles are a great question because it gets rid of the labels. If I had the choice between having Tiger Woods golf clubs or Tiger Woods golf swing, I'd rather his swing.
Yes.
Right? So I want the principle, not necessarily all the products. So I'm going to talk maybe about some specific financial products like commercial real estate or other things. But more important is, what are our reasons, rationales, goals, outcomes, and realities?
Yes.
I kind of tell folks that the fish is the last to notice that it's wet. And I'd also say that airplanes cannot fly in a vacuum. They're always surrounded by an environment.
Right.
And so most people never stop to think about their environment where they're living financially. And I mean that very literally. We think about it in terms of physical real estate properties. We want to know if we're in a floodplain or if there's some other major catastrophe that is imminent on our real estate. But what about your overall financial life? I mentioned earlier that 36% of the average American's income goes to debt financing. Yes. That's like an airplane with a headwind coming right at it. Yes. If I have an airplane, let's say, that can do 100 miles an hour and we're going from Chicago to Calgary, but all of a sudden I get this headwind coming off the mountains right in my face at 300 miles an hour, I'm going to be going backwards. I'm going to be going to Florida, not to Calgary, right?
Yes.
So what I need to do, and what most people think is the right and only thing to do, is to land the plane, wait for the wind to die down, and then wait till the wind is nil and get up and go as fast as we can, 100 miles an hour, right? That's how fast our little airplane can go. And most financial advisors, most certified financial planners are all about getting that airplane to do 103 miles an hour, 104 miles an hour. If we really stretch it, let's put all of our eggs into Bitcoin. Let's put all of our eggs into this mutual fund over here. Let's get that rate of return as nice. The problem with that is, What happens when you rev an engine for too long? If you just push it too hard for too long, what starts to happen?
Well, you redline and you blow it.
Yeah, there you go. Yeah. I mean, that's sort of how most people have lived. We've been jacked up with debt for so long that we've had to put more and more and more into riskier assets.
Yes.
Because we've lived too big a lifestyle, or whatever excuse you want to use. The biggest problem is we've taken this massive amount of debt. We say, hey, I can't save 30% like my grandparents used to. And that's according to the 1940s U.S. Commerce Bureau statistics. 30% of our income on average was saved back in the 40s.
Yes.
Now we're saving 5%. So we're taking that 5%, Shane, and we're throwing it all on the blackjack table, essentially. We're a nation of speculators, when we used to be a nation of savers. And that's a key difference there. To your point about principles, I'd say one of the biggest and best things we can do is learn to land the plane, not just wait for the wind to die down, but let's go past that. Like, what's even better than just trying to tweak our rate of return?
Yes.
Well, let's wait for the tailwind, right? Let's get that tailwind behind us, shooting us toward Calgary from Chicago at another 300 miles an hour at our back, and our 100 miles an hour our airplane can fly. We're talking about 700 miles of delta there, right, per hour. Just because we got the wind in our favor. It's about the environment that your money lives, not so much about like what rate of return we can get, or what's the specific tax advantage. It's all about, do we understand that we can control the environment where our money lives. If that happens, and we use specific particular financial products that are out there, it'll actually encourage and embolden people to do commercial real estate and to do other things with their money so that they can achieve that financial independence. Sorry, I guess the coffee's kicking in. I'll hush for a while.
No, that's all good. So maybe like when you talk about environments, maybe what does that mean? Like maybe you can give me some tangible ideas of what potential environments people's money could live in, and then that might help me really ground this.
Yeah, sure. Yeah, let's bring it down the ladder some. So, we all have, RRSPs, or in the United States, 401ks. That's an environment. Okay. So that means, what does that mean? When I put money into a dollar, if I put $1 or, Canadian dollar into a retirement account, that is a tax deferred financial vehicle. What does that word mean? Defer doesn't mean eliminate, does it?
No.
It just means wait until later, right? So if I'm thinking about this like a root canal, like paying my taxes is like getting a root canal, why would putting that off be a good idea, right? We're only going to make the problem worse if we delay, defer all that wealth and accumulation. If I put my money into, again, the RRSP, that's going to be tied typically to the stock market, which I have no control over. Again, if you control the environment where your money lives, you'll win. If Wall Street or banks control the environment where your money lives, they'll win. So that's maybe a couple of different examples there, if that helps clarify anything.
Well, and we have a similar philosophy, and that is control, right? I mean, that's one of the reasons that that's the primary driver for me investing in commercial properties is I've been in it. I have an unfair advantage over a lot of people because I've done it for as long as I have.
Yeah.
And I control it, right? I mean, those are some of my beliefs, if you will.
Sure.
So let's talk about the bank on yourself, that concept, if you will, because that's like, it's pretty fascinating, but I really am green when it comes to that. I mean, I've heard it thrown around, but I don't understand it. And so sometimes when I don't understand something, I either ignore it or I just don't pay enough attention to it. But I'm sure. Yeah. I've got you on the phone, so I want to hear this.
Right on. Cool. Yeah. So again, like if the money is in the wrong environment, you'll lose, right? If the fish is out of water, it's going to be dead. If the fish is in the right environment, it's going to not only survive, but it'll reproduce. Well, I want my money to reproduce. Yes. So most financial environments take control, to your point, away from us. Wall Street, 401ks, banks, credit cards, finance companies. And I would even say, things like real estate can take the control away. I can't get money out of that real estate deal unless I can beg a bank or find a buyer.
Yeah,
right?
It's liquid. You're right.
Yeah, it's a liquid. As great as it is, and as it creates that income, we have to weigh the pros and the cons. There's no perfect financial instrument out there. Right. One of the things that we use when we're talking about bank on yourself, we need to bring it down to a tangible financial product And again, there's no perfect financial instrument out there, but this is a strategy that I've seen work for hundreds and hundreds of clients now for their real estate investing in particular. So in general, what it is, it's a high cash value, dividend paying whole life insurance policy of all things.
Okay.
And what that is, it's not the kind that you hear Dave Ramsey or Susie Orman talking about on the radio. Typically, if you've designed it correctly, if it's a bank on yourself advisor that's designed this correctly for you, it's going to do a couple of things really nicely. One, it's increased in value, guaranteed every single year for 160 years. The returns are decent, not crazy awesome. I'll leave that to you and the deals you can find. But the cash in the policy does a nice return for if we're comparing this to cash equivalents, which is what this is. It's a cash liquid asset, so it grows guaranteed. Cash value increases every year. You can easily access the money for your real estate deals or other business investment needs. It's usually liquid enough to grab the money within a week. You can get the money out of it. Obviously,
so do you cash it in, or are you borrowing against it?
Yeah, good question. So there's two ways you can get the money out of these policies without, kicking the can, so to speak. Obviously, there is a death benefit associated with life insurance.
Yes.
But before we get our wings, so to speak, Shane, you can either cash it in, withdraw the cash out, or more especially, and to the point of bank on yourself, you can use the loan feature on whole life insurance for anything you need, whether it's fixing up your own kitchen or, plunking some money down for a commercial real estate deal. And that's really where the power of this thing really starts to shine, which we can get into. But did that answer your question?
Yeah, it does. Okay, so I'm going to break it down the way I understand it and then poke holes or correct me. So I would go out, I'd work with someone like you. I would tell you, okay, I want a whole life insurance policy of X dollars. Let's just use $100,000 just for argument's sake. So I would fund my whole life insurance policy. And is it the premiums that I pay in that I'm getting interest on at a smaller rate, if you will, that kind of grows over time? And then at some point down the line, I say, you know what, I'd actually like to be able to access that. Is it just the premiums that I've kind of paid in plus some interest, and I can either cash it in or borrow against it? Is that?
You're in the right universe. Yeah, exactly right. Yeah, close enough, I'd say. Yeah, there's obviously there's cost of insurance and other factors there, but in general, month one, year one,
yes,
within 30 days of putting money into the policy, if it's designed correctly, I keep emphasizing that, but if it's a mutual life insurance company where you own the profits of the company that you have a policy with, it's going to have liquid, accessible cash within 30 days. And you can use that for anything you choose as either a withdrawal, as you mentioned, or borrowing against it. And Shane, when you borrow against the policy, it will continue to grow as if you had not touched the money.
Huh. So what are the mistakes, or what am I not seeing? Because to your point, there's always there's never a perfect vehicle or instrument, right? And so what would be some of the things that that you tell your parents or your best friend or your here are the things that you need to be aware of.
You don't want to do this just because you're hearing it on a podcast. And you don't want to just work with any insurance agent. Again, this is something that took us several years to earn the credentials of Bank on Yourself authorized.
Yes.
So it won't work if it still means we have to save, right? So if you can't rub two pennies together, it's not going to be a good fit for us because it is still our wealth. It's putting your money in to this thing that's yours, right? So if we haven't conquered Parkinson's law, where the law of Parkinson's is expenses rise to meet income. So if we're living beyond our means, this isn't going to help us very much, right? It's also not a great strategy if you're looking for quick wins or get rich overnight. This is not get rich quick. It's tongue in cheek, I say it's get rich for sure, because it does grow guaranteed, but it's it's the tortoise in the race, right? It's slow and steady. I'd also say one more thing. If you believe you've got too many birthday candles, if you're too old, let's say, or if you've got some health concerns, don't cut yourself off. You're still eligible here. You can own a policy on a business partner that you've gone into business with. You can own it on your spouse or kids or other family members. and it's going to grow just fine. You'd be the owner, you'd control everything,
Yes.
but it would be insuring other people in your life.
That's that's really interesting. I think we'll have to have a conversation after this because frankly, I know I have insurance for my family.
Mm-hmm.
It's mainly if I go because I want to make sure that my wife is protected, but I don't pay that much attention to it, quite frankly. You know, I basically pay the premium every year, and I really have no idea what type of insurance I even have. I mean, it's not.
Well, and Shane, you're not alone. I mean, nobody was born with this information plugged into them. You know, I had to go out and search it out, right? And there's kind of two, just to keep it brief for our listeners, you know, there's two kinds of life insurance. There's the kind you rent and the kind you own. Most people, myself included, years ago had term insurance, which is renting the death benefit, which has no cash value, can't do any of the things we're talking about here. But with whole life insurance, there's an equity. There's literally you own the cash value. That's your cash. That's your equity. It's on your balance sheet. It's on your net worth. And it's yours to cash out, walk away, or leave to your family someday when you pass. But the power of this is when there's a whole life contract. Now, there's nothing wrong with term. There's nothing wrong with any financial product. They're all designed for something. I was thinking back when I was a little kid, my parents always got on me because I was playing with toys in the way they weren't really designed to be played with. You know, like I'd be throwing little dolls off the side of the house or something like that, and it was totally fun to see it happen. But it was like, wow, that's not how they were designed. They're going to break if you throw that remote controlled car off too high a ledge, even if there's a parachute on them, right? But anyway, each financial vehicle, or commercial real estate, whatever it is, whole life insurance, if you design it right and it was engineered correctly from the start, it's going to be phenomenal. And in fact, and I'll hush after this, I promise, Shane, but I believe that when you combine whole life insurance, as we've been describing, the bank on yourself type whole life policies with real estate investing, everything gets even better. Because as I mentioned, when you use the cash value for real estate investing, now we've got our money doing two things at once. It's in the real estate deal.
Yes.
And it's building on a consistent, guaranteed basis. By the way, that accessible cash is totally tax-free when I pull the money out, at least under U.S. law, current U.S. law. I'm sure it is in Canada too, but we can get that verified if you want. But the power of this is they work together really nicely.
Okay, like I work really good on examples, so we don't even need to use commercial real estate. Like, how would someone that is, say, just going, because whether they invest in a house or a commercial property, I mean, I don't think it really matters. So how does someone, maybe just give me like the bullet points, if you will, of, okay, I'm a real estate investor. I want to deploy this strategy and I want to go out and buy a rental property. How, and I know that we don't have all day to do it, but how would you be able to articulate that so that someone can say, I never knew that, like, cause I'm just learning about this today. I'm very curious.
Well, and the power of podcasting. Wow. It's amazing. I learned so much through it. So it's a privilege to get to share it with your listeners and yourself, Shane, but it's something that is so simple. We can do it in 4 steps. So you could literally fire your real estate banker with 4 steps. Let's see if I can do it quickly here. Okay. So 1, you've built up enough equity in your policy that you want to purchase some real estate. Okay. Number 2, the policy will keep on growing even on that capital you borrowed. Okay. And of course, the real estate is appreciating at the same time. So that's step number 2. And the renters, by the way, repaying that policy loan for you, which is step number 3. You control the repayment of the policy loan. Remember, you are the owner of that contract. You control, back to control, you control the entire environment where your banking is happening. Yes. So you don't have to, and it's a key thing to note for your listeners, you don't have to repay this loan during your lifetime. Obviously, it's better if you do, and if you don't, there could be some negative consequences. But generally speaking, if you manage the loan correctly, you can pass away without ever paying off that loan, and the death benefit would actually be reduced by the loan balance. So step 3 is repay the loan on your own schedule. You're in control. Maybe you even use the renter to do that. The final one, step 4, sell your property recycle the money and buy a new property the exact same way. So you're just recycling your money in and out of the policy as your own line of credit to yourself. And we have some specific numbers. I know your listeners might be driving, so I don't want to give too much math here, but I'd be happy to go into another story or specific client example if you want.
Please do. Yeah, give me an example. I love this. Like, I want to understand this more because I know that there's better ways to invest, more tax effectively or efficient, if you will. And I'm just not doing it. So give me an example. That'd be great.
Okay, I'll try to keep it brief. Again, I'll give a few numbers here, but I'll try to keep it nice and straightforward for folks listening. Okay. So let's say that you've built up enough equity in your policy that you have access to, and I've got the numbers from a real client here.
Perfect.
Names removed, of course. Yep. But this person had built up a cash value in their policy so that they could pull out. They had $400,000 in cash value. That's the money you can use. Kind of think of that like a line of credit to yourself.
Okay.
And so this gentleman decided to take a loan for $350,000 and full cash bought a house. Now, I don't know if that's maybe you could still use regular bank financing to help with, flow here. But anyway, he had the right. It's his money. He did it, right? So he bought that house for $350,000. And we calculated that it would grow at 3% a year, the property would. Okay, so over 5 years, that's a 5-year appreciation of $55,000. Okay, so from $350,000 to $405,000 is how much the value of the property grew.
Yeah.
So if he had just paid cash, literally, if he just took it out of his savings account, paid cash for that house, that's all of the appreciation. That's all the growth he would have had, a 3% deal, right? Yep. We're not counting renter income or anything here, just the appreciation.
Sure.
Let's use the policy to do the exact same thing. Okay, so the house is still going to appreciate, doesn't matter how we bought the house, right? Zillow or whatever is still going to say it's worth $405,000 after our 5-year example here. Okay. Yeah. Now, there's a loan on the policy, and policy loans are charged interest. And over 5 years, he was charged 2.1% APR, which is a pretty darn good low interest rate. Yeah. And that turned out to be $38,000 of interest that he paid back to the life insurance company. And a lot of people stop and they're like, whoa, wait a minute. There's loan interest. I'm paying interest on my own money. Dave Ramsey is ringing in my ears right now. But again, that's $38,000 of expense. We have to contend with that, realize that that's a thing when you use a life insurance loan. Life insurance companies aren't doing this for charity.
Yeah.
Okay.
Yeah, exactly. Okay.
So far, if you're keeping up with us, $55,000 of gains in the house, $38,000 negative in loan interest paid. Now, remember that the policy was still earning and growing and building without him adding any more premium in his case. So over that same 5-year period, we did the math, and the policy simultaneously earned $119,000.
Now, how risky is that? Like, is it guaranteed to go up X amount, or is it just how is that calculated?
Yeah, good question. Yeah, so that number is the guaranteed cash value accumulation. That means no matter what the stock market, real estate market, anything, it's going to grow based on purely actuarial science. So if I survive this year, the insurance company is obligated to give me an additional X dollars in my policy's cash value. On top of that, if the insurance company is profitable, they're going to give the owners of the company dividends. And who are the owners? Well, if it's a mutual company, the owners are the policy holders, you and me. So it's kind of like cake and icing, right? So the cake is the guaranteed cash accumulation. Icing is dividends on the cake. And they've only, now that I think about it, every company I work with has not missed a dividend or the guarantees in over a century. So pretty darn good. Not guaranteed, I guess, the dividends, but certainly pretty darn good for government math anyway.
That is okay. So keep going. So 2.1%, you paid $38,000, but the policy went up $119,000.
Plus the $55,000 of value in the house. Yeah. So we're looking at a total of $175,000 of total growth, or 10% rate of return, versus just 3% buying your house with cash.
And that doesn't include the fact that if this is rented out properly, you're paying down. Well, I guess in this case you have no mortgage.
Yep.
But you're paying Well, I mean, if you have no mortgage, you're probably going to have this thing rented out for $1,500 to $2,000 a month in
Sure.
just straight
Yeah.
cash flow.
Helping you either buy your next deal or maybe pay off the policy loan itself using renter money. A lot of our clients do it that way, for sure.
Right. So you can pay back the policy. Let's say you're getting 2,000 just for an example. So over a year, you 24,000. You just slap it against the policy, and then that your loan interest goes down, and then eventually you kind of build up that nest egg again.
Yep. And if you ever sell the house, where's that money going to go? Well, back in the policy to be spent again when you find the next deal if you wish.
It's unbelievable. And you can grow that policy. So you can grow that policy and take money out and not pay. So I'm just trying to understand this. Can you grow these policies tax-free, I guess, is the question?
Yep. The current law in the United States and in Canada as well is my firm understanding, but, talk with an accountant obviously in there. But life insurance has, since its inception in the United States, the IRS tax code has always given tax-free access to the cash value. And the death benefit too is income tax-free as well. So, obviously keep voting, but that's been the case for many years. And I don't see it changing anytime soon.
Wow. I'm just, I never knew this existed. I've heard some sophisticated, so maybe talk about like who typically uses these type of structures. Is this for the ultra wealthy that are aware of this? They've got, teams of people that have basically explained how to do this and set up and structured this so that they're able to kind of pass off generational wealth without triggering big tax implications. Is that really who uses this?
Shane, you bring up a great point. The more wealthy a client, the more likely they've already heard of or have this in their portfolio. That's been my anecdotal experience, Shane. But honestly, if you're I'll give you a list. If you're a wholesaler, a flipper, rehabbers, landlords, if you're a hard money lender, if you're a syndicator, if you're a commercial real estate developer or agent, if you're a residential real estate professional, or if you're just dabbling, I've seen this strategy work with all of those, folks that are in the real estate space. It really is just, it's as simple as where are we parking our cash in between the needs that we have for the cash. If anybody listening doesn't have large expenses in your life, I would be very surprised, right? Whether it's real estate expenses or heck, our own kids' college, right? You can use this for your children's education or your own house renovations or your cars or your own tax-free income and retirement just as easily as you could use it for your real estate obligations, needs, etc. So it's just anybody who needs large pools of opportunity money. I believe this does deserve at least a consideration. It's certainly not, again, it's not a cure-all. And again, the policy does cost something. So you want to factor that in. And there's no free lunch anywhere. So you want to look at that. But in my experience as a CFP, I've not found anything that is a better source of capital, because our money has to live somewhere. And I can't find anywhere else for it to sit in between the great deals that Shane brings up to all of you guys listening.
Well, I got to say, I want to have another conversation at some point and understand this more. Is there resources that someone like me or someone that's listening, like how did they learn more about this? Like this is, how do they not just get in touch with you, but is there other resources that you have that you can kind of share with people?
Sure. Yeah. If you want to just dive deeper into this, I've got a private webinar that I could send you as a link. If you go to growmorewealth.com, growmorewealth.com is a great way for you to reach out to me. If you just want to learn more about it, there's many books on the topic. The very best one, in my opinion, is The Bank on Yourself Revolution, which is written by Pamela Yellen. You should totally check that book out. It does the best job, in my opinion, of kind of giving you the pros and the cons of how this works. So, if you want to reach out to us, go to growmorewealth.com. But The Bank on Yourself Revolution book, New York Times bestseller. So it's been around for a while, but it's a great book on the topic.
Okay, that's perfect. Mark, I feel like I could just keep going deeper and deeper down the rabbit hole with you on this, and maybe we'll have to have another conversation where we can almost go into a specific example. Maybe I can even send you a deal in advance, and we could kind of look at it and say, okay, Shane, based on where you're at today, because what I've noticed is a lot of my audience, and I don't know if it's just because I talk about my family and my 3 kids and whatnot,
Mm-hmm.
but I'm finding that a lot of the people that are kind of in my world, if you will, are in a similar stage of life, right? They've made money, they have some kids, they're thinking about university, or how do I start to plan for my future? And I'm not a financial planner. Like I know
Mm-hmm.
I know commercial real estate investing and how to make money and how not to lose money for the most part. That's
Yeah.
my game, right?
Mm-hmm.
But I understand that just fits into, like your point, an environment of where does your money live, and I'm just fascinated by this, and really intrigued at learning more and educating myself. So maybe we'll have to have a conversation after and figure out maybe how that could look to.
Sure. Yeah. And I will say for the Canadian audience, yeah, there's a number of specific advisors who are Bank on Yourself authorized. They're all across Canada too. So, for other countries outside of US and Canada,
Yes.
I have, I guess less good news to share for folks outside of these 2 countries, but there are a few others, Australia, I know the UK, but you really want to do your own due diligence, make sure the advisor that you're working with is, authorized to do this right. It's the difference between the words all natural at the grocery store and USDA organic here in the United States. There may be something similar in Canada as well,
Yeah.
but you want to make sure that you've got an absolute guarantee that you've had the right advisor design this correctly. It's like getting into a car that wasn't engineered right. It's not safe. So you want to make sure you've done this right from the get-go, and then it really just works, just works after that.
Yeah. I
Happy
love
to
it.
chat.
Yeah, Mark, I really appreciate the time. I've learned a ton, and that's what's so cool about these kind of podcasts is that you get to meet new people, have really interesting conversations, and it's all geared to the same outcome, which is financial independence, financial freedom,
Yeah.
and there's just different avenues on how to get there. So
We're living in
really
the
appreciate
future for sure. It's if our cars and our commutes can be turned into libraries, I mean, wow, what excuse do we have? It's amazing. So thank you again, Shane. It's my pleasure. I hope it's helped serve your listeners.
Yeah, no, this has been great. I'll make sure I have all the show notes and links to the resources Mark mentioned. And yeah, we'll talk soon. Thanks, Mark.
Thank you.